Right, we are now live, I think. So, hi there, everyone. Thanks so much for joining us this afternoon for our panel discussion, where, as the title would suggest, we're aiming to shine a spotlight on capital markets. I guess what that means for me is really taking a deep dive into how technology is fundamentally transforming capital markets for the better, the opportunities that remain going forward, and ultimately how can we can ensure that this positive direction of travel is maintained or even accelerated. So in terms of who you'll be hearing from today, Andi Kazeroonian, investor at Outward VC. For those who aren't familiar with Outward, we are an early stage venture capital fund focused on investing in the future leaders of FinTech and enterprise tech. If you want to learn more, just follow us on LinkedIn and Twitter. And genuinely really excited to be joined by our panelists today who have insights that truly span across the entire spectrum of the capital markets ecosystem. So in no particular order, there's Anand Sambasivan, co-founder and CEO of PrimaryBid, which also happens to be one of our portfolio companies. Hello, Anand.
Hi.
Charlie Walker, head of equity primary markets at the London Stock Exchange. Lucinda Hedley, UK head of FS strategy and capital markets partner at Deloitte. And last but not least, Suneel Hargunani, head of equity capital markets at Citigroup. So, hello everyone.
Hi.
I think it's fair to say that we have quite a lot we'd like to cover across this topic. That can, we'll try and keep it as concise as possible, but also to stress to the audience tuned in that we are going to keep some time at the end for Q&A, and we will try our very best to get through as many questions as we can. So please do flood the questions in throughout the session, and we will do our best to get to them at the end. So, without further ado, I suggest we jump in. So, in terms of the first area I'd like to explore, we as investors in this space have become really fascinated with this concept of capital markets become a real kind of force for good in the world, and that looks, that can look very differently. We've seen the cost of participation being drastically reduced. We've seen access to new asset classes being opened up. And I guess more deeper into the infrastructure, we've seen some kind of fundamental transformations into the underlying infrastructure that powers the market, which can have a whole host of benefits to all its participants. So the first question I'd like to ask to all of the panelists is, what areas have you seen technology drive the most significant and positive impact? And where do you think the impact is still to come? And I'd like to start with Suneel, given that your day-to-day has probably transformed more than anyone's based on what it was like pre-COVID. So I'd like to start with you.
Thanks, Andy, and good afternoon, everyone. I guess the first point that I would make is that COVID hasn't stopped capital formation. If you just look at the amounts that's raised, global ECM volumes have been the strongest H1 first half since 2015. That's actually the third highest level in the last 30 years as well. How much has been raised globally? About just under $500 billion has been raised globally in equity. And if we break that down to EMEA, so Europe, Middle East, and Africa, that's about $90 billion. So firstly, the crisis hasn't impacted capital raisings. In fact, it's actually accelerated it because a lot of corporates have had to turn to the equity market to bolster their balance sheet. But focusing specifically on technology, how has that impacted the capital raising process? Well, I think it's impacted it for good in a positive way. And I mean in terms of the process. There's much more efficiency in the process. I think the one thing about banking and capital markets, it was probably or has probably been less disrupted than, let's say, the markets businesses and banking, where you've seen a lot of change over the years in terms of trading platforms, etc. Whereas the advisory businesses and the capital markets businesses have still pretty much done things the way they were done, a decade ago or decades ago. So one important thing, if we think about an IPO process, a UK IPO is typically in the public domain for 4 weeks. That's 2 weeks, what we call PDIE, pre-deal investor education, where the research analysts educate the buy side with a research note and go around meeting them. And then 2 weeks management roadshow and book building, where the book is built, orders are taken, and then the deal is priced. So 4 weeks overall. What's changed? Well, obviously, both those parts of a process have had to go virtual. given the lack of ability to have physical meetings. But what does that mean? Essentially, there's more flexibility in terms of timing. There's more flexibility in terms of amount of investors that can be met, either because of the lack of travel, and therefore you don't need to go to a European country to meet 2 or 3 institutional investors. You can just slot that during the day. But also you can do more broader group webinars to speak to more institutions at the same time. So it enables broader marketing and education. And with that, you don't necessarily need 2 weeks of investor education to get around to the same group of investors, or same breadth of investors that you needed to do. So less market exposure, essentially. Obviously, there's a reduction in logistics costs, printing, research, travel, hotels, etc. But the best example I would say, in May 2020, so in the depths of the crisis, a company called JDE Peet's priced a 2.6 billion euro IPO on Euronext Amsterdam. JDE Peet's essentially the world's largest pure play coffee and tea group. So as you can imagine, I'm sure a lot of us here, we've been having a lot of tea and coffee at home while working from home. So you can imagine it's a business that was already pretty strong but benefited from the crisis. The reason why I bring this up is that typically that IPO would have taken 4 weeks in the public domain. It took 10 days from launch to pricing because of all the reasons that I gave. Admittedly, it was a well-known company and there was a lot of marketing before we went into lockdown from an early look perspective, but essentially the investor education process took 5 days, and then the book building and roadshow took a similar amount again. So as I think about technology, and as I think about even when things get to normal, we'll go back to normal, we have been very concerned in the UK and in Europe about the IPO process being too long, taking too much market exposure. 4 weeks market exposure is a long time in volatile markets. In the US, for example, it is only a 2-week process because you don't have the investor education. Having said that, technology seems to have found a solution for us to reduce the amount of market exposure. And even when we can physically meet, I believe this will enable the 4-week process to go down to 2 or 3 weeks. And I think that's definitely a positive, not just from a market exposure perspective, but also breadth of education and how many institutions and investors can actually have a look at an IPO.
So I guess keeping on that theme of, you mentioned it's the advisory business has probably been a bit slower to kind of adopt technological change, but there is now that kind of openness and appetite to be exploring new solutions. And you've seen kind of PrimaryBid be one of the beneficiaries of this. So how have you seen that, not just impacting PrimaryBid, but what wider kind of technology impacts have you seen over the last few years, and where do you see the kind of opportunity ahead?
Thanks, Andy. Look, I think despite all the technology-driven change around us, to just echo some of the things Suneel said, it's fair to say that primary capital markets remains strangely familiar to when I started as an investment banker almost 20 years ago. And look, that's not to say it's functioning poorly or badly, as we've seen public markets mobilize incredibly quickly over COVID and deliver capital at remarkable scale. I think the latest numbers we've seen in the UK is 25 billion pounds raised this year. The US, it's $250 billion and counting, right? So at PrimaryBid, the question we ask is, who gets to buy these deals, these discounted offerings? And historically, the smaller investors were excluded because they were simply too fragmented, deals were too time sensitive, and there was all of this administrative burden that went on in taking these orders. So by pointing technology to these specific roadblocks, we've been able to unlock this incredible high quality pool of capital for companies and investment banks, open up this new asset class to retail investors, and ultimately create a fairer and better sense of inclusivity in the transaction process. This led us to do deals with companies like Compass Group, Ocado, Taylor Wimpey, Segro, William Hill. I think a couple of those, I think Taylor Wimpey and William Hill, we're privileged to work with Suneel and team. Look, this was never possible before this, and has to be a force for good in my view.
Okay, great. And I think it would be interesting to, Charlie has given LSER a strategic partner of PrimaryBid, and I guess you're able to see technology in quite a holistic view, given you plug into so many participants in the ecosystem. what's been the LSE view of the kind of real technological change that have been occurring over the next few years, and looking forward, where do you see it most playing out?
So I think as you say, most of the technology impacts in capital, not all of it, but most of it over the last decade or two has really been on the secondary market side. I mean, even going back to the 80s, right? Open outcry getting replaced with electronic trading, but more recently you've seen, high touch phone broking moving to algorithmic trading. You've seen the rise of high frequency trading. You've seen the cost of transactions coming down as transactions are being able to be executed by computers. You've seen some platforms now offering free trading. So you've seen a raft of changes on the secondary market side. You've seen new products as well that have been enabled by technology. So the rise of exchange traded funds, hopefully everyone is aware of by now, has been incredible. There's now almost 140 billion pounds tracking the FTSE 100. And if you go back 10 years ago, that number was about 40. So all of this has been enabled by technology. And I think the common theme that we see sort of across the markets is investors wanting more information about the public markets. They want to make more informed choices, and they want to have more direct engagement in those markets. And I think if you think culturally, why would that be? People are able to take more ownership over their financial future. So technology has enabled them across industries, not just in capital markets, to get access to information that previously maybe only a select group of people could get. And with people taking more ownership over their financial futures, whether that be through pensions or ISAs, that's something that we certainly are seeing quite a lot of. Green and sustainable investing is an example of that. People purposefully directing where their money is going into socially responsible funds. It's one of the biggest growth areas for funds under management at the moment. And whilst technology has enabled it, you've also seen regulation enabling it as well. You've seen in the UK, you've seen requirements around fee disclosures that asset managers charge becoming more prevalent. You've seen regulation around making it easier for people to switch between providers in recent years. You've seen more flexibility being given to people around how do they invest their pension pots. And all of this really is about providing people with more information so they can make better choices. And I think that's what technology is driving. I don't think that's just limited to capital markets. I think you could apply that same mantra across many industries, but it's definitely something that we've seen in capital markets. I think as Suneel and Anand said, the interesting thing is the primary markets have probably been the market that's been least impacted by technology. But the interesting thing is, it's not, and as Anand says, it's not that they were working badly. It's just that there are probably more enhancements to be made on the secondary side. I think what the recent epidemic has given people is the ability to do things in a different way without the normal perceived risk of it. In other words, people have been forced to engage in processes which ordinarily, if it's not broken, why fix it kind of mentality. And we've definitely been seeing that over the last 4 or 5 months. And hopefully, once we all come out of this pandemic, we can take the best bits of the technology that's been used through this to enhance the way that we do business as usual.
That's interesting. I guess moving to Lucinda, I think so far we've heard a number of things that I suppose a lot of the participants in the market see. The ability to invest at a low cost, the ability to participate in a primary offerings. I know that you have quite a lot of insight and involvement into the things that one perhaps doesn't see in terms of the actual kind of trading infrastructure that is powering that ultimately is quite important to power some of the innovation that you do see. So what kind of insights have you what can you share around
Sure.
the space of the last few years?
I think to some of Charlie's points, obviously capital markets has always been a technology driven business, and he's made some of that clear through proximity to exchanges for arbitrage trading, etc. And I think over the past kind of 20 years or so, we saw big banks building their own systems, building their own platforms, and really being at the forefront of the technology agenda. I think given where we are in terms of regulation, in terms of ROE, we're now seeing a dramatic change in that approach to upgrade of technology. And I think there are enablers to that, such as cloud and ability to rent capacity and processing power in a different way. than was available even five, certainly 10 years ago. So it's no longer about huge platform replacements. It's about provision of processing capacity, abstracting data sets away from some of these mainframe architectures into form light application layers and microservice architectures that ultimately drive better ability to gain insight and analytics, but also do that at a much preferred price point.
Okay,
yeah, carry on.
No, sorry. So I was going to say I want to pick up on something that Anand mentioned earlier about the kind of the primary markets becoming fairer for retail, and Charlie, you kind of mentioned around the cost being dramatically lowered and more information being offered. I think it's therefore difficult to argue against the fact that the technology has drastically opened up the market for retail for the reasons we've discussed. I guess what I would like to get your view on is there such a thing? Well, I guess first of all, is what does so to set the context, PrimaryBid's mission is to democratize capital markets. What does a truly democratic and open market for retail look like in capital markets? And how can technology get us there in your view?
Sure. Let's look at public equities as an asset class, right? And I start with the premise that public equities are open to every investor to buy in, and the primary market is an extension of that, and to some degree should reflect it. Of course, there are nuances here that will be discussed by Suneel, I'm sure. But what good looks like for me is when the primary market reflects the secondary market. That means specifically low to zero cost of transaction. It means simple digitized access. It means complete transparency. And it also means a level of investor being investor agnostic. In the primary market, I think historically, the smaller investors were largely ignored in favor of the larger ones. Now, we've made major strides in achieving this. I think opening up deals to retail investors that I talked about with 80 plus companies on the London Stock Exchange. But to get to this perfect world, Andy, I think it's more than just a technology gap. It really needs broad ecosystem buy-in for this to work. And we know it, the companies want it. The companies are eager to enfranchise this base, but it is the stock exchanges, the investment banks, the syndicate desks, the deal advisors, the regulators, all of whom have to play a part in promoting this agenda. We are not naive enough to think that we're doing this alone and being successful alone. This is very much a partnership model. And what we've done is a joint effort by the thought leaders of, for example, the panelists on this call. And it's these participants that promote the buy-in and foster the fairness by sort of adopting the small upgrade to the capital markets.
Okay. I think with that context set in terms of, I guess, what a good and open market looks like for the retail investor, be it from technology and otherwise, a question to Charlie, first of all, given that the LSE does work hand in hand with the regulators and government, is there such a thing as too open a market for the retail investor, given that a big focus historically has been on protecting retail? And if that is the case, where can technology, do you think, play a part in terms of mitigating some of that risk?
So I think, just to follow up on a point that Anand made, so if you look at equity ownership, direct sort of equity ownership, which I guess you could classify as being retail, on AIM, it's about 30% of the market, and in the main market, it's about 10%. So to Anand's point, you've had a situation where the primary markets haven't necessarily reflected the ownership in the secondary markets. And that's something that I think could be balanced out a little bit more. I think the way that we tend to think about sort of opening things up to retail is we tend to think about the logistical problems of accessing retail and then the regulatory restrictions around accessing retail. And we don't think technology changes the latter of those, right? There are regulatory restrictions. We think there should be regulatory restrictions. Not every sophisticated product is appropriate, and there are regulatory restrictions. So that is certainly not what our intentional goal of using technology is to change the regulatory requirements around retail. Really what the goal is to remove the logistical barriers to it. Before very recently, the idea of trying to access tens of thousands of retail investors over a 3 or 4 hour book build was impossible. It was just logistically impossible. And even in an IPO process, it was logistically onerous. And in my previous life, I used to work at a bank and I used to do these. And so I have the experience there to say it was quite logistically painful. That's what technology can help solve. It can help access that group of investors, literally tens of thousands of investors, through a seamless technology platform in a short period of time. It doesn't change the regulatory requirements, nor do we necessarily think it should change the regulatory requirements, but it can address the logistical requirements. And we think that is certainly an improvement in the capital markets.
Okay, thanks. And then Suneel, I guess, whereas Charlie is coming from a more, I guess, working with regulators and governments and being the exchange, I'm interested to hear your view, given that, you know, Citi or within your role at Citi, you'll be servicing the institutional clients. So I guess the same question to you is, from your perspective, is there such thing as too open a market for the retail investor? And again, if so, do you see any way technology can fill that gap? So for instance, it's, you know, there's, we see often a danger in other asset classes when retail are able to come in alongside larger investors, of there being quite a stark information gap at the point in which they invest. So where do you see technology potentially fitting in trying to bridge that information gap in things like primary offerings?
Yeah, no, it's a good question. And by the way, look, I echo everything that Anand and Charlie have said. That the fact is, in the UK and in Europe, there hasn't been as much of an equity culture as there has been in the US. And if you look at US deals, most of them have a large tranche going to retail. And the problem with Europe is that with the cycles, you get retail dipping in and out. And therefore, when we work with our corporate clients and issuers, there's always the pros and cons of, do we do a retail offer and don't we? And then, you know, that goes to show, you know, that pros cons has swung quite a lot in favor of pros, with technology helping the primary offers because it takes away a lot of the logistical burden. But to your point, so look, I'm in favor of more retail in primary deals. But yes, there is an information advantage currently to institutional investors. I described the IPO process and the fact that institutional investors get, you know, research notes, management access, prospectus, etc. Clearly, a lot of that can be provided to retail investors as well through a technological platform. The other challenge, and it comes with MiFID actually, and so this is not, you know, the banks having institutional clients as their clients and not necessarily retail clients. When we allocate any deal, we are allocating on behalf of the issuing client. So not the relationship with the institutional client or how much commissions, etc. they pay us. That is all not known to our side of the business, and that can't be factored into early allocations. So with that vein, when we are going through with an issuing client in terms of who we should allocate, the fact that retail investors, or knowledge around them and how they behave and how they trade and what shareholdings they own and all the factors we consider in terms of who are the best long-term shareholders for our issuing client, retail doesn't necessarily stack up highly, and therefore allocations and how much they should get, particularly in a deal that's oversubscribed, you know, will not be high versus, you know, giving more to a major institutional investor, for example. So I would say there's two things that need to change. Firstly, I think we sort of need to have tranching. I think we need to adopt, you know, be it a 5 or 10% tranche carve out to deals that goes to retail. So you're not trying to compare the two, because it isn't a fair playing field, and it won't be a fair playing field with the regulation and the lens that we have on how we allocate deals. And then once we've tranched out and we say that X% is going to retail, and by the way, this is what retail tranches are, and we have them in many deals, but the logistical nature means it's not that common. We use technology to make sure we narrow that information advantage. You know, we look and find ways from a legal and compliance perspective. Can retail get access to research notes or some form of third-party research? Can we make sure that any platform they can click in and they see the prospectus, which has to happen, and they make their investment decisions on it as well? Are there on every deal webinars for retail to join like this to make sure they see the management presentation as well? All of that is possible. We've seen that. You know, we've been treating institutional investors essentially like retail with technology, and they're not getting the one-on-one face service. So we know that technology can solve it, and that I think will reduce the information advantage that institutions have, but it all has to go hand in hand with regulatory guidance and the fact that there isn't visibility on who the retail is and how they act. You know, retail is often seen as shorter term investors or day traders, but the reality is, you know, you could argue that retail investors can be longer as well because of the pension. But we've got to use technology to make sure that they're given the same amount of information, and therefore, you know, similar decision making can be made around that group.
Yeah, great, thanks for that. It's really, really helpful. And Lucinda, I don't know if you have anything to add to that, or in addition, whether you see anything on the kind of infrastructure side playing a part in retail, perhaps being, from a technological perspective, it being more straightforward for retail to be involved in some of these processes, which either bridges the information gap or provides access to these deals.
Yeah, I mean, I think the comment from my side of it, further down the track in the infrastructure area, is the current technological landscape democratizing the ability for multiple players to be involved, smaller retail as well as larger institutional. And I think that that's an enormously exciting possibility. I think to everyone else's points, it also needs to be framed against the context of regulation and conduct, and making sure that we're being responsible in that space as well.
You're on mute, Andy.
Sorry, thanks for that. I'm going to come back to you, Lucinda, for this next topic, which I'm going to switch gears slightly and talk around the concept of partner versus challenge. So I think this is, whether it's capital markets or any form of tech, this is always an age-old argument. Do you challenge the incumbents? Do you partner a kind of a distribution versus innovation trade-off? But with capital markets, it's slightly different, because as we've discussed, there are so many different types of participants involved within a transaction, both in primary and secondary, that it's actually very key. It becomes far more important that you are able to partner in this, you know, in order to drive technological change. However, that doesn't mean it's straightforward. And as I said, because all of these parties are so different between old world and new, it becomes really challenging. And often you see kind of new challengers and startups or old incumbents pointing the finger at the other, saying, you know, they're the reason why this didn't work. So I guess question to you, Lucinda, is based on your kind of experience of working with big tech, scale-ups, incumbent, be it banks or financial services or otherwise, what do you think is the kind of best alchemy or kind of the best ingredients for a kind of fruitful and effective partnership between a challenger startup and a kind of big tech or an incumbent financial services firm?
Yeah, I mean, look, I think partnership is the key word there, right? And I think those that you know, the providers that have the ability to create that network effect, but also the ability to wait and have the money to be able to do that. I think that's really where the challenge is. And so, you know, the big incumbents are used to dealing with the big banks that we're talking about and the big infrastructure providers that we're talking about. I think some of the smaller challenger fintechs have got fantastic solutions, but can't necessarily afford to wait around to create that network effect and or go through the procurement processes of these large players. That's certainly where my organization and organizations like mine come in to help provide the partnership and that network effect and some of that transformation capability to align and join some of the bigger incumbent providers with some of the smaller fintech solutions. I don't think that there is a perfect alchemy, because I think we're talking about lots of different technology types and players as well, some of which are providing point solutions, some of which are providing large platforms to help create that network and orchestration effect. But it's definitely something that the smaller providers need to be aware of as they embark on the journey with their big clients.
Okay, great. And that's quite a nice segue into the fact that, you know, PrimaryBid and LSE have already launched, you know, a while back successfully a partnership in the market. So I guess from both of your perspectives, starting with Anand, is what do you see as the kind of right balance and the right ingredient for partnering? And then on top of that, what scenarios do you believe it makes most sense to challenge and not partner?
Look, partnerships is the bedrock of our business model. That's how we think about growing both in our domestic and international markets. So we've got an incredible partnership with London Stock Exchange. We're really proud of it in the UK and in continental Europe with Euronext. But these are officially signed partnerships. Now, that doesn't mean we don't have other partnerships. Now, we feel equally partnered with the investment banks that we work with. So when we did the Taylor Wimpey and William Hill deal with Citi, we were very open and transparent with how we worked, and we feel a kinship and a partnership with them, and similarly with the law firms and deal advisors, PR companies, distribution venues, and so on. And our approach is very simple. At least with PrimaryBid, it's we strongly believe in a win-win approach. We don't think what we're doing is a zero-sum game, so it does sort of increase the pie, and hence we can all win. Now, the key to success, I would say, well, at least our key to success was starting off with a collaborative spirit, and looking at the London Stock Exchange deal and so on. It's quite a simple process. We signed NDAs. We shared data and information. We understood the core of the problems we're trying to solve, and found synergies in a joint approach. And that worked really, really well. And it did take long, right? It does take 6 to 12 months. We have to accept it, to Lucinda's point. And yes, there is a problem, and some fintechs or some startups are have a solvency issue in that time. And there are ways around it, right? If we were running out of money and we'd signed a sort of letter of intent with London Stock Exchange, I'm certain we could find investors with long-term view to back that and see that to fruition, and all the network effects that came from it. The other thing I'd say is, look, I think there are ulterior motives stink, and they can be spotted a mile off. So it is really important to come in with a partnership mindset, and this works both ways. It's like a startup trying to ultimately disrupt something. It's pretty clear that's the ultimate objective, and vice versa. And I'll give an example of an experience we had, obviously on a no names basis. It was very early in our journey. It was a big global financial institution, but it was clear. The red flags were evident from start. No NDA signed. They were asked to open up a data room. All information went one way. There was nothing collaborative about it. Nothing coming back to us. And ultimately ended up in a car crash, and we learned a lot from it. And then when I compare that to our experience with the London Stock Exchange and Euronext, it's night and day, and it's evident from the very beginning. And although it takes long, and that doesn't mean you won't see progress, and you're not excited about the progress. And even though it's a 6 to 12 month exercise, you're excited and motivated along the way. You're learning things, you're sharing, you're collaborating. This isn't just a long, drawn-out exercise. It's actually a really fun, discovery period between these institutions.
Great. And then Charlie, from the kind of the LSE's perspective, not just in terms of PrimaryBid, but really the LSE are increasingly partnering, sometimes even investing in the case of Navora, with businesses in this space. So how are LSE viewing kind of strategic partnerships with technology firms?
So I think, partnerships generally, we're very supportive of. I think, capital markets is quite unique. It's quite difficult. It's very difficult to get people to do things differently to the way they've done them historically. The risks associated with it going wrong are, larger than in many industries. And so partnering with partners in the market is, it's a good way of making sure that everyone's got the same objective, and of actually driving change. So, London Stock Exchange Group in its entirety has had many partnerships, whether it's the London Clearing House or whether it's Turquoise, a pan-European trading platform. You mentioned Navora. It's a model that we're quite familiar with and think works for everyone. I think when it comes to innovation, I guess in your definition, we'd be the incumbent and the old guard. Which I guess the exchange is 300 odd years old, so I guess by definition we are. But I've got to say, internally, the desire for innovation is is very prevalent. I think we're very conscious that you can't rest on your laurels, and that things naturally do change and should change, and therefore if they can change for the benefit of the customers and the companies and the clients that we work with, that's really something that we should be at the forefront of. And there are some innovations that we do internally, and we think that we're best placed to do them internally. And there are others where we think, actually, do you know what, partnering with someone externally that has a mission which is complementary to ours, but which they're probably in a better position for one reason or another to execute on. PrimaryBid is a great example of that. That's where we're very supportive of doing those. And what's great is that in London, we've got such a fantastic ecosystem of fintechs which have been supported from the government level, from the regulatory level, and it really feels like it's grown in prowess over the last 5 to 10 years or so. That the number of these companies that are approaching the LSE for these types of partnerships, and the quality of some of them really has, I think, even it's kind of blown us away. We've been really quite impressed with it.
So on that, you've obviously discussed about the volume of potential partnership opportunities, and you've already discussed kind of mission alignment in terms of working with a startup. But what does a startup kind of practically have to do or be to be equipped to enter into a partnership with LSE or a kind of larger incumbent firm to actually make it work?
To be honest with you, it's so specific on the precise company. I mean, I think the mission is critical. What is it that they're trying to do, and is it going to benefit the ecosystem around the exchange? Because the exchange is really just a meeting point, right? That's at its heart, that's what it is. So if the mission is going to help the people around the exchange, then that's something we're interested in. Clearly it needs to be resilient. Clearly it needs to be able to support itself financially. But we look at things on such a case-by-case basis that I don't think that there's certainly not a tick box. And also it's worth noting we haven't done many of these, right? We've done a few of them, but it's been pretty few and far between.
Yeah, great, thanks. And Suneel, Anand already mentioned that Citi have partnered with PrimaryBid on a number of transactions. How does the investment banking world view partnerships with startups?
Yeah, look, I think that's a tougher question, because ultimately the investment banking world, investment banks also pride themselves on having large technology departments and are trying to be innovative themselves. Having said that, we have to recognize that in the capital raising process, there is more to go in terms of tech innovation and disruption to the process. That will make it a more efficient process. But if we think about the process, it starts all the way from origination and identifying the business opportunity, the structuring, the execution work, and then the marketing, the book building, the pricing, and then the settlement backend aspects, right? There is a lot that goes in to that. And you have to overlay the banking, the legal, the compliance, the accountancy work, and obviously the exchange regulatory work on top of all of that. There is a lot of process there that can probably be more efficient. There is a lot of process there that can be, or that is duplicative, and that tech can help solve. And so where we look at it from a banking perspective is identify the problem, identify the challenge. So if I take PrimaryBid as an example, what was the problem with the challenge? That retail investors weren't getting the same level of access to capital raisings, even though they were shareholders, and institutional investors who were shareholders were getting that access and were being allowed to avoid dilution on a capital raise that's not preempted by not a rights issue. So identify the problem, partner with other stakeholders in the situation. So in this case, it's the exchange, but obviously PrimaryBid also did approach the banks, the corporates, the advisors, etc. And as a bank, we have to accept that's a problem. We have to accept that it's beneficial to our clients, and there's many clients in any form of capital raising here. Clearly, from a corporate client perspective, it is beneficial to be servicing their retail shareholders or their institutional shareholders, and accept that this is an efficient way of doing it that's not going to lengthen the process, that's not going to add a cost that is outweighs the benefit, and that can plug and play into the system. And then clearly banks will try and determine, is this something they can do themselves or not? The reality is that the capital raising process, I agree with what Lucinda was saying. A lot of these startups have to go into various bits of the process, and it makes more sense often for a third party to do it than a bank to reinvent what they're doing. And so that's how a bank would look into it. So it's still a partnership model, but it's very much a lens of what is the problem, can it benefit our clients, and is it something that we should develop in the capital raising process? And I'm one to accept that, as we go about it, the capital raising process will become more efficient, will become more reliant on technology, and ultimately it should be a better marketplace for corporates and investors to meet.
Okay, great. It's good to hear. So I think it's probably about time we move over to our Q&A portion of the session. Again, to our audience, if you have any questions, please do fire away. We'll do our best to get through them. So the first question is a very interesting one, actually, and I think everyone's got their own specific take on this. So what is the current state of affairs of the old promise of blockchain for capital markets? Lucinda, I see a smile on your face. I'm going to start with you because I'm sure you've seen a number of this, especially in your world of kind of back-end trading infrastructure.
Yeah. I mean, look, I don't think it's a promise that has gone away, and I think it's something that is still being experimented with and explored, right? But what it doesn't do, the blockchain doesn't represent a bridge from A to B. It is, and it comes back to our conversation around network and all the participants having to be involved and the market infrastructure being aligned as well. And blockchain represents a whole new way of working and operating across all of those counterparties and stakeholders. And therefore it's kind of, it's Big Bang. And I wonder whether our industry as a whole is ready for Big Bang. Based on what we just discussed, it's kind of incremental steps. Now, that said, we've just done COVID, right? We've seen a Big Bang in terms of the way we've been working right now. So it's not to say it might never happen. It's definitely still being looked at and experimented with. But my challenge with it, I suppose, is in the immediate term, it represents a very big step for the industry. But I'll let others, I mean, Charlie, you should probably come in from a stock exchange perspective.
And given the investment in Navora as well, who I know are quite, the kind of their infrastructure is built around blockchain.
Yeah.
So how do the LSE view that?
Well, Navora does several things. So it's not just the blockchain element of it. I think, listen, internally there are people a lot closer to this than I am, to be honest with you. I think the challenge that we always find, and this is across capital markets infrastructure, is that in order to drive change, there needs to be a significant improvement, be that cost or be that efficiency. Because again, the risks associated with it are great. And normally the cost of changing systems is great as well. Because all of these systems are embedded across literally thousands of financial service providers. At the moment, I'm not sure that there has been a strong enough case put forward yet as to what the incremental efficiency and pricing benefit would be versus the cost of implementing it. Now, that's not to say we won't get there in the future. It may well do, but at the moment, I think there's a little bit further to go on that.
Okay, great. Anand, any view on blockchain in the capital market space?
Look, I'll give you our view, and we did think about how we could sort of implement blockchain strategy, and ultimately it was a very quick thought process, and we didn't want to do it for the sake of doing it. The point is, we were looking to solve a very specific problem that we've seen in our lives in the capital markets, and that solution didn't require blockchain as of now. As and when it does, and when the exchanges and when the banks start adopting this in a more meaningful way, we can be very quick and nimble and adapt to it. But as of now, it doesn't factor into our thinking on how we solve problems.
Okay. And Suneel, any appetite for blockchain-based IPOs at Citigroup, or?
Look, I think like any bank, we have teams that are focused on blockchain and how they can help our industry. I think there's other areas, within the finance industry that blockchain is going to materialize before IPOs and capital raising. I think the numbers I gave to you show that the ability for corporates to raise equity capital in its current form is well and truly working. But I think personally that the capital markets and IPOs will be further down the list in terms of adopting blockchain. I think it needs to prove itself in other areas first, and the jury's still out on how or when it will do that.
Yeah, and I think you've all made the same points of why we have kind of struggled somewhat from an investment perspective with regards to blockchain and capital markets. Charlie, you mentioned around material improvement in terms of, you need to see that kind of 10x improvement from the existing way of doing things in order to build a kind of compelling investment case. But more importantly, I think we also said the network piece of how important that was. Lucinda, you mentioned that it's because of how these kind of systems work, and you have so many parts required to actually make it work. It's sort of a game of chicken. It's difficult to build an investment case around something unless everyone is using it, and no one wants to use it until it's got a serious amount of investment. So it's a kind of chicken egg type situation. That's why with all of these things, typically, especially in capital markets, with something that, as you said, Lucinda, is big bang, it typically needs a consortium of users to kind of group together to decide, okay, we are now going to use blockchain as our trading infrastructure, and we're going to put money into it and make it work. I think without that, it actually becomes very challenging to kind of uproot capital markets infrastructure to a blockchain-based one. But things change very quickly. I could be wrong, so we'll see how it pans out. I think we've got another question that's come in, and it's probably aimed more at Charlie and Suneel. So the question is, fintech is huge in China. Previously, Chinese fintech companies go to New York for overseas IPOs. With the current political situation, that route is essentially closed. So can London replace New York, and will we see more Chinese companies list on the LSE? And I think it'll be Chinese tech companies list on the LSE.
So I think the one of the unique things about the LSE is actually the percentage of companies on it that aren't UK companies. So at the moment, it's just under 40% of the companies listed are sort of quote unquote non-UK companies. And that's on the company side. On the investor side, now less than half the securities that are listed on the LSE are owned by UK-based fund managers. So whether you look at it from the companies coming to the exchange or you look at it from the investor side, it's one of the most global markets in the world. If you look at the amount of companies that are raising cross-border IPO capital, so companies that are going outside of their home market, there's been a real trend over recent years of that increasing. And again, the LSE has been the biggest recipient of that globally, more than NYSE, more than NASDAQ. Africa, Middle East, Europe, CIS, even the Americas. China historically has been a smaller proportion of that. Whereas you say a lot of those companies have historically gone to New York. The LSE and Shanghai Stock Exchange actually built the first ever structural connection between the two exchanges, which launched last June. And for the first time, it allows companies to be listed on both exchanges, and for investors to buy a share on one exchange and to instruct their broker to sell it on the other. And it's the first time that that's ever happened. So the links between the capital markets has been growing. And I think the amount of interest that we've been getting from Chinese companies to come to London was growing anyway. I'd like to think that the offering of London is strong enough that we don't necessarily need the political situation in the US. I think we were seeing that trend before that. But, there's no doubt that, China will be an important capital market going forward. It's also worth noting it's not just from the exchange perspective. London is now the largest offshore trading center in the world for renminbi. You've got China A shares going into global indices. It's a broader picture than I think just listings.
Okay. And so I've just had another question come in that I think Anand in particular, you should have quite a strong view on. And the question is, as technology improves access and information flow, is the €8 million retail limit for EU secondary public offerings still appropriate? Can and should the UK take a lead in reforming this?
Look, you know where I stand. It's absolutely right. And look, the number used to be 5. It's moved up to 8, and it's kind of an arbitrary thing. And it's no one's fault. There was no data around it. It was hard to gauge what that number should be, if anything. Right? Potentially, it should just reflect, as Charlie mentioned earlier in this webinar, a percentage of a deal, or Charlie or Suneel. versus a hard cap of any kind. What the good news is, as we're doing deals and we're seeing the demand come in, we're able to actually provide data and sort of thoughtful analytics on what sort of levels of participation retail investors are interested in. And what's particularly compelling is, look, as companies, they've stopped using us for just shareholder enfranchisement. They're actually starting to look at us as broader stakeholder enfranchisement. So last few deals, so whether it was Countryside, Aston Martin, Taylor Wimpey, and a few others, they're saying, hey, let's also include an employee offering alongside a retail shareholder offering. And soon we want to sort of translate this to also customer type offerings for big consumer brands. So that number is just going to get bigger and bigger. And this is such a unique opportunity for the individual investor to truly connect with a company, whether that they're associated with, whether they're a shareholder, customer, an employee. And we have the data to say, well, actually, we're seeing this sort of volume for deals over this sort of time periods, and we can be really helpful in helping inform what that number should be. So should it be 8? The answer is absolutely not. And I think there needs to be, it's a really opportune time for the UK to think about changing it and be thought leaders in this space.
Carly, I'm sure you're relatively close to this, given how closely the LSE work with the regulators and government. So anything to add to that?
No, not really. And it's a decision for the regulators as to what they decide the right limit is. But I don't have anything meaningful to add above that.
Okay, so Suneel, let's assume that the cap does get raised. Let's say no cap, 50 million of demand comes in. How does the bank view that? Are they getting the allocation, or is a €8 million a bit of a neat kind of?
Well, so the good thing is with all things, you learn and you adapt. And Anand referred to data. Yeah, ultimately the data can help justify the greater allocation or the lifting of the cap. Essentially, I alluded to beforehand, the challenge or the concerns that the industry has with over allocating to. And I call it retail, and I'm being very broad. The individual investor, or the private investor, or the private wealth, manager. In that it's a bit more of a black box than institutional investor, where you have a greater history and a track record in terms of how they invest and how they trade after. And so the more deals that are done, the more data that's collected, the more justification there is, to increase the cap, but also determine what the appropriate level of allocation should be, to ensure we have a fully functioning primary market and a healthy aftermarket, which is what the issuing client will want. So it goes back to the point. Maybe it's a percentage of the deal. I don't know. I don't know what the number is. If it's 50 million, do they get 50 million? If it's a 100 million deal and it's 50 million, probably unlikely, because you also have to weigh up the amount of capital that group has versus the amount of capital that the institutional group has. But it's clear that it is growing. There's a growing influence on capital raising, and we should be learning from the current wave of deals to determine the best path going forward, and to continue to evolve as well. I don't think it should necessarily be a static limit. I think investors and PrimaryBid's clients, for example, will also evolve and learn, become more sophisticated as well, and that will only help participation going forward too.
Okay, well, there seems to be increasing noise coming out about the potential of being lifted, so let's see how it plays out. I'm going to close out the session, so thank you for everyone who posted their questions. We did our very best to get through as many as possible. I'd like to close out with one last quick question and ask you all to kind of get out your crystal balls and look into the future. I guess the question is, what do you think will be the most noticeable difference in the capital markets industry in 10 years' time? And I'd like to start with Lucinda.
So I think I think the democratization of technology and that sitting in the cloud and public cloud, I think is definitely a trend that we're seeing at the moment. And I think as part of that, the access to the processing power of data and analytics will be huge in terms of driving insight and the industry as a whole.
Charlie?
Yeah, I completely agree with that. I think that one of the biggest changes will be the amount of information that's available to investors across the market, and the ability that they'll have to access and take ownership over their financial future. I think will be a big change where they're directing their capital, whether that's ESG or active or passive or whatever it is, over the next 10 years or so.
Yeah, and Suneel, I think we've kind of discussed that. Probably your part of your area of capital market in terms of advisory probably hasn't moved very much in the last 10 years. But do you see kind of quite a significant shift either in that area of the market or otherwise in 10 years' time?
Yeah, I think what's going to change, and we started to see it, is sort of how companies raise capital, how companies become public, and I think that's in two forms. Firstly, we're starting to see more and more money raised privately, i.e. investors going earlier in the ecosystem. I think globally year to date, about 100 billion plus has been raised, privately. That's up 10%, year on year. We're going to continue to see that theme and trend. And then likewise, how companies go public. There's been a lot of articles, a lot of focus on SPACs in the US, which has had tremendous growth this year, over 15 billion raised in the US in SPACs. And essentially, nothing's going to replace the IPO, but there are three ways that a corporate or company can think about going public. One is the traditional IPO. Two is the direct listing. There was a lot of press on that when Spotify did it, for example. And now we're seeing the SPAC, or what we call the back end of the SPAC, i.e. an acquisition vehicle, buying a private company and the company becoming listed as a result, being an alternative as well. So the optionality for private companies and how they think about listing, and it's going to vary from company to company, which is appropriate, and then also how early in the ecosystem the traditional institutional investor goes in to provide equity capital to a company.
Yeah, I completely agree with you. And finally, Anand.
I think it's going to be the acceleration of the adoption of technology is going to be much quicker than it has been in the past, and it's going to lead to significant benefits, including transparency, costs, fairness, inclusivity, all of those things, which, by the way, is something that everybody in the capital markets wants to see happen. So I think there's a big buy-in for it, and I genuinely expect it to happen in the coming years.
Very good. And amazingly, we are bang on time. So ladies and guys, thank you so much for your time this afternoon. It's been genuinely real pleasure to speak and hear your views and insights. And I'm sure the audience would agree. And I'd like to thank them also for listening in, and I hope you enjoyed it. So thanks very much and enjoy the rest of your afternoons.
Amazing. Thanks.